Welcome to this IFRS Keys presentation by BhalaGood. I'm Glynis Carthy, and in episode 5 of the coronavirus series, I'll be taking you through some of the considerations when you are looking at an impairment of a non-financial asset. The next slide includes information on what is in the scope of IAS 36 and what is not, and that's very important to consider to make sure that you're applying the correct accounting standard to the asset that you are testing for impairment. I won't be discussing it. Instead, what I'll be focusing on are the situations when an asset should be tested for impairment, whether COVID-19 is actually an indicator of impairment, and then whether we should be having changes to inputs and assumptions and maybe considering some of those. This slide outlines when we are required to test for impairment. What you'll see on the left-hand side is that there are three situations in which an annual impairment test is required. In other words, we don't even need to consider whether there's an indicator of impairment. And what those three situations are is, first of all, an intangible asset that has got an indefinite useful life. Secondly, an intangible asset that is not yet available for use. And then thirdly, goodwill. However, what IAS 36 also says is that even if, for example, you've just tested goodwill for impairment, and then you come to the next, let's say you've done that at year end, and then you come to the next reporting period, the interim, you may well then realize that in actual fact there is still an indicator of impairment for goodwill because this pandemic has now come along. And in that situation, you would have to test goodwill for impairment again because IAS 36 says is at a minimum you do it annually. However, you also do it when there's an indicator of impairment. For all other assets, in other words, those other than the ones listed on the left, you would need to assess at every reporting date whether there's an indicator of impairment, and only if there is an indicator of impairment do you actually estimate recoverable amount to determine whether that asset is impaired. The question of whether COVID-19 is automatically an indicator of impairment is an interesting one. For me, I think that the consequences from the pandemic are so pervasive that I would expect every company to be discussing something about the consequences of COVID-19 on its business. And in the vast majority of cases, I would say yes, COVID-19 is certainly going to be an indicator of impairment. But perhaps not just the fact that it exists, but really the consequences of its existence. So we've seen lower demands for goods or services, companies having to refund goods or services or give discounts or rebates even when they wouldn't normally, simply because a customer is not able to pay. We've seen companies having to incur higher costs, still pay employees when they're not getting benefits from that employee providing any service. Obviously, increased cash flow problems, and then in a listed environment, the carrying amount of net assets exceeding the market capitalization of that company. So yes, lots to indicate that we certainly should be viewing COVID-19 as an indicator of impairment. Just a reminder, so if we do have an indicator of impairment, we're required to calculate recoverable amount. And what we do when we're calculating recoverable amount is to look at the higher of the fair value less the cost of disposal. So that's pointing us towards IFRS 13 on fair value, or we calculate value in use. And then if the carrying amount is higher than the recoverable amount, we have an impairment. More attention should be given to the inputs and the assumptions in this phase. So we definitely cannot just copy what was done before, because what we're supposed to be doing when we're looking at, for example, discounting cash flows is to look at the inputs and the assumptions that a market participant would use, bearing in mind what the risks are and the situation is at the reporting date or the date that we're actually doing the impairment test. So it's far more likely, given all the uncertainties and risks that are arising at the moment, that we're going to need to do several cash flows to assign probabilities to changes in cash flows to get to the recoverable amount. And just a few things to consider is that obviously cash flows may have reduced. But even if they haven't actually reduced, the timing thereof might have changed. So they might have been, the cash flows might have been pushed out further, and so you need to plot them differently. The forecast growth rates could obviously be a lot lower than previously expected. And what we might well find is if we haven't adjusted the cash flows themselves, then the discount rates may need to be higher for the fact that there's this increased risk that has arisen as a result of the coronavirus pandemic. So it may not necessarily be that we're adding a coronavirus premium as such. We might be adjusting that in the cash flows themselves when we assigning the probabilities to the changes in cash flows, but certainly we need to consider whether the discount rates do need to be altered. Finally, please remember to look carefully at the disclosure requirements in IAS 36 because they are extensive and are going to be very carefully looked at by users and by regulators during this phase, and also obviously judgments, estimates, and sensitivity analysis in IAS 1. Thank you for listening to this presentation. I look forward to being with you in the future.